That second leg down broke a lot of long-term supports, not just in the equity markets, but across a number of indicators. Doesn't mean you're going to head lower, but it means your downside risk, if you do, is a little bit lower than before. So as we look at things right now, the fundamentals remain good. You have strong corporate earnings, economic growth remains fine, inflation's still benign, but we've got some volatility, and we've got a couple of key events coming up, both the December 1st meeting with Presidents Trump and Xi, and then the Fed meeting in December that could offer a lot of volatility between now and the end of the year.
This is seasonably a strong time of the year. We've mentioned it many times before on this show, and many of our viewers know it and listeners know it. What is it about this particular end of year that maybe has you a little bit more concerned, more than you normally are?
I think the Fed is the key here. The Fed has 5 rate hikes scheduled in the dot plots. 1 more this year, 3 next year, and then 1 in 2020. We think at a minimum they need to cancel those last 2. We're seeing some stresses in the real estate markets. We're seeing some stresses in the auto markets. The dollar's a little bit stronger. International growth is weaker. I think if the Fed pulls back, I think that normal seasonality will kick into play. I think we've got a good consumer going into Christmas this year, but we need the Fed to get out of the way a little bit.
Does it worry you a little bit then that we are seeing some of Jim Cramer's comments about CEOs speaking to him, saying that they're seeing a little bit of a slowdown, that they're a little bit worried about the late cycle side of things?
Yeah, I think we need to, yes, but we need to separate it. We're not on the verge of recession in our view. What we have going on is we were at 4.5% GDP growth, 20 to 25% earnings growth, with a stimulative fiscal policy and an accommodative Fed. What we're going to is 3% GDP growth, 10 to 15% earnings growth, and a neutral Fed and fiscal policy. Those are all fine, but that adjustment can cause some volatility and concern, and we need to make sure we don't get too aggressive on the monetary policy and then roll ourselves over into something more sinister.
All right, so Steve, let's assume that that scenario that you just outlined plays out. Slightly less GDP, the economic dynamics are still growing, but just not as robustly. What kind of investing do you do at that point?
Yeah, I think you do. So a couple things. You put together your list of things that you think are overly beat up right now. And if you think the Fed will pause next year, maybe that's value cyclicals, energy, financials, industrials. Maybe it's the dividend names that have gotten beaten up. And in any event, we would suggest that folks focus on adding good, diversified multi-asset strategies that can be flexible and navigate that volatility.
Steve, you know what sector or industry seems very beaten up to me right now that people may want to either think about or stay away from, and that's semiconductor stocks. So would you be going into semiconductor stocks given that kind of a profile? They have been beaten up, to be very fair.
They had such a great run, and they are drivers of a lot of the industrial revolution technologies that we talk so much about. They're also very cyclical. So again, I think if you get a pause from that Fed and people are less worried about us being at the end of a cycle or having a policy error, yes, but I think we still need to see the all clear from the Fed on this.
On the global side of things, should investors here still be looking for those values outside the U.S., emerging markets, perhaps some developed markets that have been trailing the U.S. over the course of the past couple of years?
I think for international markets, you're getting hit by 3 things. You're getting hit by kind of the trade rhetoric. You're also getting hit by the strong dollar and then rising interest rates. So I don't want to sound like a broken record, but if the Fed pulls back, there's some opportunities there. I wouldn't hold your breath on trade. I think that that's a longer-term issue. Again, put your list together. And then if you get the all clear from some of those indicators, yes. But I think that's more of a 2019 story. I think you've got better opportunities between now and the end of the year with some beaten up U.S. sectors.
On the bond side of things, we've noticed that there has been this trend, at least medium term, for higher bond yields. They have pulled back a little bit, to be fair, now. But do bonds represent a more competitive asset class given the revaluation in rates that we've seen?
So we don't think so. We're still overweight equities based on what we think are stronger fundamentals. Don't forget cash. Cash is yielding 2.25% at this point, and you don't have some of that duration risk that you have in bonds. Look, we think that rates are going to move higher over time. We think they're only going to grind higher, not shoot higher, but we still don't see a real compelling opportunity in bonds relative to stocks.
All right, so